Hey, good morning, everybody. Marty Mazzora, March 22nd, 2019. Big sell-off today, you've probably noticed, so I thought I'd jump in here and work with the chart a little bit on your behalf. If you didn't catch this morning's log entry, please do that when you have a chance. It's in your email inbox. And this weekend, could be tomorrow, could be Sunday. I'm going to wait till I do my scoring of our macro index before I offer up the weekly message. We're going to want to dig deeper into economics and see what the setup is fundamentally and so on. As for this morning's big sell-off, if you've been following me on the blog this week, you may recall I came into the week feeling pretty optimistic, pretty constructive, in fact, based on my last weekend's technical analysis of various sectors and just market conditions and how things were trading. But I also said in the commentary where I expressed those things that a antagonistic tweet about China could flip my constructive narrative on its head. I also mentioned Brexit and could be any other things as well. My first spark of skepticism came not from a tweet, but from China when there was a report that they were walking back some of their promises on intellectual property. Found out later as I dug in that they were doing that in response to the US not willing to unwind the latest tariffs, and then got confirmation on that from the president Wednesday morning. I suddenly became very skeptical about the market's short-term prospects at that moment. The big rally on the Fed announcement made sense to me, but then the big sell-off the minute the press conference was over made sense to me based on the earlier trade commentary of the day. Yesterday, I would have been completely offsides as a short-term trader because I really thought that follow-through was going to come yesterday. So we had that huge rally. Well, as I speak, the Dow is down 392 points. So we're getting that today. And while we did get some weak data out of Germany, we had Indonesian Airlines cancel some Boeing 737 orders, although it's a fraction of what they have on order in terms of overall Boeing has on order with World Airlines. The Indonesian airline is probably going to replace that with a Boeing model, another one. However, if that is the beginning of a trend, that of course would be very problematic for Boeing stock, even if they do revert to another model. Don't know that that's going to be the case, but that had maybe some marginal impact because it is a big component in the Dow. But we are seeing a global across the board sell-off today. I think that is appropriate given my concerns over trade, and I think it's necessary because as I've stated here on the videos, and I think I've stated in the written blog, and I've certainly stated in client meetings, my concern about this big rally here is it will embolden the US side of the table to start playing some hardball again like it did up in here. I'm not saying there aren't issues related to trade with China, but they're not the trade deficit issues. In fact, frankly, we're probably a year away from China posting trade deficits itself going forward with the rest of the world. And that's simply because they are developing quite quickly and their consumers are becoming spenders more so than savers. So advanced nations tend to have trade deficits with many of the advancing or emerging nations, largely because of their level of, again, advancement and the savings and spending habits of their people. The benefit of a trade deficit for a country that prints its own currency and is issuing a lot of debt, like the US is that the amount that the surplus country is not spending on goods in the printing country, in this case the US, is coming in to fund the government. So China is the biggest foreign buyer of US treasuries, largely because they're sitting on the dollars when you and I buy the stuff we want at the best world prices. So my caution to the administration is be very, very careful what you ask for. If indeed, as President Trump wants to see, we get more buying of US goods from China, we're going to get less buying of treasuries, and that's going to be an issue, particularly as it relates to interest rates. So we'll see how that shakes out. Intellectual property theft, forced technology transfer, that is really bad stuff, and that needs to be addressed on a global scale. I want us to be aggressive against that. I want to work with our partners because the whole world complains about that, but don't want to do it with tariffs. Tariffs are economy killers. History has proven that over and over and over again. So anyway, so here we are. So I want you to understand why protectionism concerns me so much. We revert back to kind of that hardball rhetoric, and I can assure you folks, if it sticks, we're going to revert back to these December 24 levels in the market. I don't suspect that there's the stomach to get there. As I said in the blog earlier today, the administration is very market centric. I do not want them to give up on hitting China on the intellectual property and forced technology transfer. I do not, but I do want them to get rid of the tariffs and go at that problem in a different way. If they do that, I think we're going to see this bull market resume with some momentum, and we'll feel very good about global conditions. Right now, global conditions are suffering largely at the weight of angst over trade, disruption of global supply chains, and everything that comes with it. Anyway, thank you for suffering through that rambling. Let me just give you a couple of things on the chart here. From a technical perspective, too, a little skepticism here is warranted. So here is the trend line of price here currently. Here we were as the market was beginning to top. You may recall I wrote an article right about here. It said expect a rough patch. I was expecting something like this, was not expecting everything that we got, frankly. So on balance volume, I've explained that many times here. I think it's worth looking at. It gives you a feel for whether stocks are being accumulated or distributed. This was really, really bullish. We talked about that the whole time up in here. Contrast that with the market right in here when the S&P was getting toppy, and I wrote that article, Expect a Rough Patch. As you can see, on balance volume was dropping precipitously, and this, frankly, folks, is a sign that we are seeing distribution as opposed to accumulation of stocks. This is accumulation. Right in here, it's somewhat bearish, somewhat ambiguous. It's not as bearish as it was here, but not nearly as bullish as it was coming up in here. And then the moving average convergence divergence, the momentum oscillator, as you can see, it was diverging in bearish form there. We were pretty good. You expect to see some rolling over here, and then as you accelerate, you pick up steam again. This is a bearish divergence. These are signals that market sentiment was beginning to wane right in here. I think this can turn on a dime and get higher, but it's going to be based, frankly, on good, positive, constructive news on trade relationships, not just with China, that's step one, but also with Europe shortly thereafter. I'll keep you posted. Again, the weekly message is going to really focus on underlying conditions and the longer term things that we look at. Thank you as always for watching and listening. Be back very soon. Take care.